If you're thinking about buying a home, but down payment is your biggest obstacle, this video is for you. I'm going to show you why I love the down payment assistance programs and why it might be the key for you to get into your first home. Let's get started. Today's agenda: why I love DPA. DPA is short for down payment assistance. You can hear that acronym through this whole video. What is down payment assistance? Some common myths about down payment assistance. Who's a good fit for down payment assistance? Pros and cons for DPA. Should you buy today or keep renting? And next steps if you're interested in learning more. That's me, Jesse Rivera. I'm a mortgage broker in the state of California. I am an expert in down payment assistance programs, and I love working with first-time home buyers. This is not an AI generated voiceover. This is me. You're going to hear all my mistakes. I'm going to try and do it in one sitting. So uh, be generous with me. Don't hate me too much for all my mistakes. Okay, so why do I love down payment assistance? Number one, it gets buyers into homes now. If you're struggling to save for your down payment, this may be an answer for you. It might get you into a home now, right? Waiting to save for down payment. I talked to a lot of people who have been saving for their down payment for years, and it's a big struggle for them. But in all that time, they've lost equity. Prices have still gone up. So if they would about 3 years ago with a down payment assistance program, their home today would be worth considerably more. There's a first mistake. Actually, there's a lot of mistakes so far. Home prices are going up, interest rates are going up, and buyers just can't keep up, right? They can't catch up. So that's why I love the DPA. So what is a down payment assistance? Simply money for down payment. There are lenders, there are government programs, there are county programs. But mostly I work with the lender programs because they're the best ones. Um, it can be a loan, which is usually a second mortgage they put on the house for the down payment, or it can be a grant. Um, some need to be repaid. Some of these grants need to be repaid. The second loan always needs to be repaid, and some don't. Actually, some of the second loans can fall off after 3 to 5 years. Very interesting. There's a lot of different types of programs out there. And sometimes you can get money for closing costs as well if you want to do that. There are pros and cons to these, and we're going to talk more about that in a little bit. So let's talk about some common myths about DPA. Common myths. Myth number one: DPA is only for first-time home buyers. The reality is that's false. There are programs with this restriction that need to be first-time home buyers, but there are several programs that you don't need to be a first-time home buyer. So if you own a home now and need to upgrade or downgrade, just don't have the down payment, we can help you out. Another myth: it's a much more difficult process. That's very false. So the lenders I work with, the process is just the same. In fact, the lenders usually are the ones that do the down payment assistance, so they don't have to go to a third party to get approved as well. So if you get approved with the lender, you get approved for the down payment assistance. So the turn times are regular turn times. So regular loan is about 3 to 4 weeks. We can do it in 3 to 4 weeks, no problem. Another myth: DPA is only for inexpensive homes. The reality is we have some programs that will do high balance. So like LA County, Orange County, we can go up to $1.2 million. So it depends on your county what high balance is. And if you actually have high balance, some counties do not. We just might have to go with the conforming uh, loan amounts in your county. Another myth: it's harder to get sellers to accept DPAs. That's not true, not really. In fact, when I do my pre-approval letter, I put how much down payment you're going to put down, but I don't tell them where it's coming from. It can be coming from your bank account, can be coming from mom and dad, or it can be coming from the down payment assistance. They don't know that. So sellers really don't know. Listing agents really don't know. So it's not a big deal, but you always want to have an experienced loan officer and an experienced real estate agent on your side. And sometimes we want to do lender approval, right? Which just means before you make an offer, we upload the file with a lender and it goes through underwriting just to catch anything. that might throw us off during escrow. So the lender and the underwriter prove it. So you're all approved, ready to go, and all we need to do is find a property for you. That's a very powerful thing. We do that a lot. So who is a good fit for the down payment assistance program? So usually you need good income, decent credit, but you just have not been able to save for down payment. So let's talk about this a little bit more. When lenders look at you, when you're buying a house, trying to get a mortgage, what lenders look at, they look at three things. They look at your income, they look at your credit, and they look at how much money you have for down payment and closing costs. So what does good income mean? So you have to be able to afford the house. They look at how much money you make and what your expenses are, like car loans, student loans, credit cards, all that stuff. So they take your income, subtract all your monthly expenses, and that's how much we can use for to get the mortgage. You have to be able to afford the house, or you won't get it. That's number one. Decent credit doesn't have to be perfect. Does not have to be perfect. For most of the down payment assistance programs, it's either 620 or 640 credit. You cannot have any bankruptcies or foreclosures in the last 7 years. But you don't need 750 credit for these programs. Mostly, a lot of them are just FHA loans with a down payment assistance on top. Um, just not have been able to save for down payments. This is for someone who has decent income, decent credit, just not just haven't saved for down payment. That's a lot of people, right? Starter homes. Sometimes it's best to do starter homes, but like I said, we can do more expensive homes as well. So this is a good fit for people with good income and decent credit. Okay, if you have bad income, if you don't have enough money coming in each month, or your expenses are super high, not a good fit for you. If your credit is, 500 or 520 or 550, probably not a good fit for you. But one of the things we can do is we can figure out what you got to do to get your credit score up. Um, I'm the kind of loan officer that I'll work with you. I want to get you into a house, whether it's today, whether it's a month from now, whether it's 6 months, whether it's 5 years from now. Let's figure it out. How do we get you there? Okay. Um, it's a good fit for people just haven't been able to save for down payment. Okay. Single or married professionals that have not had time to save for DPA and want to buy ASAP. Okay. Single and married professionals make good money, usually have decent credit, just don't have enough money in the bank to do it. Okay. Single or married that make good money but live paycheck to paycheck. That's a lot of people, right? I see, and I'm included. A lot of times, we tend to spend as much as we make. Okay, and that's fine. As long as you're making good money, good credit, let's get you into a house. And the only way you're going to build wealth is through home ownership. If you're this kind of person who does not have if you're not the kind of person who puts money away every month, saves, uh, puts money into their retirement, puts money away, this might be a good thing for you. I call it a forced savings plan, right? Uh, because as your home increases in value each year, your equity goes up and up. So it's kind of like a forced savings plan. Okay, a lot of people are able to put away stuff each month, but there are a good amount of people who just don't have that kind of discipline, and this is the perfect program for you. Who is not a good fit for you? Marginal income. You just don't make enough money uh, to pay your mortgage, and this is something big with mortgage companies, and it's big with me as well because by law I have to make sure, and the lender has to make sure that you are able to afford that mortgage, taxes, and insurance. Okay, bad credit. Yeah, we'll send you to credit repair, like I said. Unstable employment. That's kind of a big one. It's hard to buy a house uh, if you're jumping from job to job. Um, we need 2 years of employment, whether you're self-employed or whether you work a W-2 job. We can use your past education. So let's say if you just graduated from college, you're as a CPA and you've been working for a CPA company for uh, 9 months and you want to buy a house. That's fine. We need 2 years, but we can use your education because it's related to your job. But we do need 2 years. Okay. Let's look at the pros and cons. I'm going to start with the cons first. It's a higher interest rate. On the forgivable or the grants, it's usually a higher interest, maybe 1%, 1.5% higher. Okay, these are banks. They make their money somehow. They're, they're not charities. They need to make their money somehow. So if they're going to give you money that they're not going to get back, they're going to make it up in a higher interest rate, and then you won't be able to sell or refi maybe 3 years, maybe 5 years, depending on the program. They need to make their money back. Okay, a higher monthly payment. So if it's just a second mortgage that you have to pay back, um, you'll have your regular mortgage, but you'll also have a second mortgage on top of it. Some programs have no payments for the seconds during the duration. Some programs you do have to make a payment on the second, so it depends on which one. The higher payment, higher rate equals higher income requirements, right? If you have a higher interest rate, that means your monthly mortgage is going to be higher. If you have a higher monthly payment because you have a second on top, that means you're going to have a higher mortgage payment. So you need to make more money to cover that stuff. That's why the people who are a good fit make decent income and good credit. Okay. Some programs have income restrictions, not all. Um, some programs look at the county median income, family income, household income, and kind of take a percentage of that. But there are several new programs that it doesn't matter how much you make, so that's kind of cool. Some require you to be a first-time home buyer, not all anymore. About half of them do, half of them don't. A higher loan to value at closing, which just means you might be underwater. You will be underwater uh, if you get a down payment assistance program, if you use down payment assistance, which just means your mortgage is going to be higher than the value of your home. Okay, that sounds kind of scary, but you could also borrow closing costs as well. Um, but if your mortgage is higher than the value of your home, you need to plan on staying in your home for at least 5 years to make this work. If you're not sure if you're going to be in the same city for at least 5 years, you should not be doing this program, okay? Because this is the kind of program where you need to stay in the home for years and years and let the value of your home increase every year so that it makes sense. That's the only way this makes sense, right? Okay? The only way this makes sense is if you believe home prices will continue to go up, like I do. And I'm going to show you why I believe that later on in this video and why I believe that this is a good program, even though when you move into your house, your mortgage is going to be worth more than your home. Okay, sounds scary, but I'm going to show you why it's worth it. Money for down payment is a pro, right? Of course. Money for closing costs, you can get money for closing costs as well. So theoretically, you can buy a home with no out-of-pocket money. That's crazy, isn't it? But theoretically, you can. Um, I'm not sure I would do that, but if you want, we can talk about that. You may not have to pay the money back. There are programs where it's just a grant. There are programs that it's a second mortgage, but it goes away a little every year. So after 3 years, after 5 years, it's gone. Okay, so there's some very interesting programs out there. You can buy sooner and take advantage of rising home prices. This is the biggest value. This is the biggest pro of down payment assistance. It lets you buy now instead of having to wait 5 years, 10 years to make to save for that down payment because homes are appreciating and they will continue to appreciate historically. You know, it might go down one year, might go up next year, but if you look at 5 years, 10 years, your home is going to be worth a lot more than it is today. So that's what we want. We want you to get you into a home today so that you can take advantage of the rising home prices. You can get money for closing costs. That's a pro. You can refinance when rate goes down and get a much better rate. So when rates go down, cross my fingers, in the next year, 2 years, 3 years, whenever it is, we can refinance you, get rid of that down payment assistance program if it makes sense, and get you a much better interest rate and a much better monthly payment. And you can, like I said, you can even get rid of the down payment assistance when you refinance. Okay. So should you buy today or should you keep renting? So let's talk about that a little bit. Buy today or keep renting. Why I think you should buy today. Here's some reasons, and I'm going to give you more details about these reasons in a second. Way more people in California that want to buy than there are homes. Okay, that's interesting. Home prices will continue to rise historically over the long term, and homeowners' net worth is 40 times on average as compared to a renter. Let's look deeper into this. Okay, so the state of California believes that we need to create 325,000 homes each year, new homes each year, for to satisfy the people who want to buy a home. Okay, so uh, this is how many we've been building year by year. This is the state goal up here, so you can see that we are well short. In 2024, we built about 120, so we're about 200,000 homes short. You can see that there's much greater demand than there is supply for homes right now. So let's just say basic economics, right? If there's more demand for something, than there is a supply for something, prices will go up, and that's why home prices keep going up in the state of California. Historically, home prices go up. Okay, this is a graph starting in 1990 here, all the way up to 2024, and you'll see how much home prices have gone up. And here's the Great Recession, and we had a big hit on home prices, and then it started going up again. Okay, but even with this big hit on the Great Recession, which by the way was caused by lenders who would give mortgage to anybody, if you could fog a mirror, you would get a mortgage. So most of these people defaulted, a lot of foreclosures, home prices went down. Around here, new laws were initiated that made all this stuff, all the shenanigans, illegal. So we have to make sure that you can afford the house. So this is not going to happen. I'm not saying home prices won't go down. You can see they go up and down, right? They go up a little bit, they go down a little bit, go up a little bit. This is COVID. This is when interest rates got to 3% and things went crazy. And then they go up and down, right? So we're going to see it go up and down. So since 1990, up to 2024, even with the big recession, even with the ups and downs, home prices on average went up 4.2% a year. So even with these big things, which probably won't happen anymore, home prices still went up. If you would take, if you would start here, where all the new laws were enacted, and home price, and kind of just went into a normal cycle of going up, from here to today, without looking at the Great Recession, home prices went up 7.2% a year. So home prices still go up every year. Historically, if you went back another 50 years, you would see the graph go up and up and up. Okay. Um, Here's another point. Homeowners' net worth is almost 40 times greater than those of renters. Okay, 40 times. That's insane. So renters have a net worth on average, and this is the United States. This is not just California, of 10,400. Most homeowners have a net worth of about $396,200. Home buying is the greatest way to make sure that you have more net worth and that you have a good retirement. I was a member of Rotary in my local city here in Long Beach for a long time, and there's a lot of retired people in there, and they have a great retirement. It's not because they were great at picking stocks or they had a business and they sold it. The only reason they have a fantastic retirement is they bought a home in their 20s or 30s or 40s, made the payments. If they needed a bigger home, they sold that home, took all that equity and put it into the new home. And every year, just like up here, their home prices went up and up and up and up and up to the point where when they got to 30 years or 20 years, when they're almost paid off, they had a ton of equity, right? A ton of equity. And so when it came time for them to retire, they were okay. They were doing okay. Renters, on the other hand, most renters live paycheck to paycheck, right? They don't put money away for their retirement. They barely have enough. I heard that 70% of people who rent, if they had a car payment, if they had to fix a car for $2,000, they wouldn't have that money. It would put them into shock, a payment of shock. So that's why I love homeownership. I believe in homeownership. That's why I love down payment assistance. Okay, have I convinced you? I hope you have. I hope I have. So what are next steps? Watch this video. Watch it again. Hear all my mistakes and watch it again. That's okay. Uh, I hope I got my points across even through all my mistakes. I am not a TV news anchor, so please bear with me. Fill out the form below. On this page, you'll see a form down there. Once I get the information, I will run the numbers and see if you're a good fit. We could talk about it, see what we can do, what a good program for you is. If we decide to move forward, complete an application, get pre-approved, start looking at making offers, and get your home accepted, get your offer accepted, go through escrow, and move in. Okay, so that's it. Thanks for watching. Please fill out the form if you're interested at all. Or if you just have questions, give me a call. 562-576-6885. My phone number is on the site. And so just please give me a call. And I look forward to talking to you. Bye.